Hi guys, this is Sylvia of CPDbox.com. Welcome to this video with my answer to one of your questions. So if you want me to respond some of your own questions this way, you can always visit CPDbox.com and contact me via contact form. And if the answer to your question can serve and help more people, then I will make an effort and a video like this one. I'll try to make it regular as much as possible, so stay tuned, sign up for my free newsletter on CPDbox.com and never miss an update, and you can even sign up on this channel and never miss a new video. This is the question asked by Deepanjan from Botswana, and let me read it. Hi Sylvia, greetings from Botswana. Which closing exchange rate to use for translation at the year-end? Buy rate, mid-rate, sell rate? We have lots of assets and liabilities denominated in foreign currencies, and we need to translate all monetary items with the closing rate at the end of the reporting period. The question is, what closing rate shall we use? There is more than one closing exchange rate stated in our country: mid-rate, buy rate, sell rate. While the differences would be quite material. This is a great question because that's a very practical issue that many accountants face, so let me answer that. In some cases, the differences in exchange rates are small, and the total impact of using different rates would be not significant for your financial statements, and you can use the mid-rate in this case. Well, it's the spot rate. In my own country, we use euro, and for translating the year-end balances of monetary assets and liabilities, we use the closing spot rate of euro to foreign currency as declared by the European Central Bank. However, in other circumstances, when there's more than one rate, the differences can affect your financial statements a lot. In this case, IAS 21 prescribes that when several exchange rates are available, the rate used is that at which the future cash flows represented by the transaction or the balance could have been settled if those cash flows had occurred at the measurement date that's stated in the paragraph 26 of IAS 21. Therefore, you always have to ask, if the foreign currency receivable is paid now at the reporting date, at what rate will it be converted on our bank account? Your receivables and other monetary assets would be settled at the buy rate, and your payables and other monetary liabilities at the sell rate. Why? Well, the buy rate is the rate at which the bank buys the foreign currency from you, and therefore when you have the receivable in foreign currency, you will get the foreign currency and you will sell it to the bank, and the bank will buy it from you at the buy rate. That's why you translate the assets at the buy rate. On the other hand, the sell rate is the rate at which the bank sells the foreign currency to you. So if you have payable in foreign currency, you need to buy that foreign currency from the bank first in order to pay that payable, and the bank will sell it to you at the sell rate. If this is too hard to remember, just remember the simple help or mnemonic. It is always beneficial for the bank, not for you. So, if you have $1,000 US dollars and you need euros, the buy rate is 1.2 and the sell rate is $1.1 per euro. Which rate is okay to apply? At the buy rate of 1.2, $1,000 is, let me calculate, 833 euros. And at the sell rate of 1.1, $1,000 is 909 euros. What amount would you get if you bring your 1,000 US dollars to the bank? The lower amount, of course. So you translate your asset of 1,000 US dollars with the buy rate of 1.2, and that would be 833 euros. On the other hand, if you have to pay $1,000 to someone, but you have just euros, how much you need to pay to the bank to get US dollars? Well, the higher amount, 909 euros. So you translate your liability of 1,000 US dollars with the sell rate of 1.1, and that would be 909 euros. Let me warn you here that you should apply these rates consistently. That means always mid-rate or always buy-sell rates. You can't just apply the mid-rate once and then the buy-sell rate. You have to be consistent from period to period. Oh, and I have one bonus question. What if in your country there is some official exchange rate and an unofficial exchange rate? And what if you're using an unofficial rate and that rate is widely and legally used? In this case, you can apply the unofficial rate for your translation, but only if you can strongly prove that the transactions can be, will be, or were settled at that rate. Before the end of this episode, let me add a little disclaimer. This information is not a substitute from a professional judgment of CPA of your own situation and circumstances, and you should consult CPA or other qualified professional. That's it. So, thanks to Deepa and John for this great question, and thank you for being here till the end. Please share this video with your friends if you liked it, subscribe if you haven't done that already, and head to CPDbox.com. Thanks and bye!